2023 hasn't been easy on investors, but luckily we have the president and CEO, Brent Wilsey from Wilsey Asset Management, to offer some sound advice. Brent, good morning.
Good morning.
Tough year for some investors.
It is. Things just started getting better, then they got worse again, and people's emotions and their patience are starting to wear out. We had a bad 2022, now here we are at 2023, things were getting better. Now the 10-year treasury hit 4.8%, markets go down. The only thing that's worked this year is technology, but that's about the only thing that's worked, and most people are not happy, and their patience have pretty much run out.
So we were just talking off camera, and you said you think the worst is behind us and that this quarter, the fourth quarter, is going to be a good one.
Yeah, because I mean, we had a bad year so far this year because our rates rise, and what that did, that spooks investors, spooks the markets, markets go down, and that is pretty much over. I think we're in the ninth inning of that ball game, because when I look at what happened on Friday with the jobs report, we had a good jobs report. 336,000 jobs were created, which usually is a bad thing, but because the wage growth is slowing down, that's what Chairman Powell was worried about, was wage growth. Well, that's slowing down. So now I think going forward will be fine. And also too, on Thursday this week, we have the inflation report, the CPI comes out, Consumer Price Index. I think that's going to be tame. I don't see any more interest rate hikes for the end of the year until I don't think we'll have them again. I think things are looking that good. And what that means that interest rates will stabilize and investors will come back and the right equities will go up.
So how should people be investing right now?
Yeah, what they need to be investing in right now is look at what's going to work. Unfortunately, growth investing is still too high. Valuations are high. We talk about Apple, which is a great company, but for the last 3 quarters, we think this fourth quarter as well, their earnings are not growing the way they were, and they traded a very high, they're very expensive, a high multiple, so that's not good. Eventually that will come down, and they're not alone with that. So what you want to do is find companies that have not done well over the last, we'll say 6, 12, 18 months, because they're on sale, and that's what you want to find. So if you have in your 401k, you're investing, stay away from things like the growth funds. Growth funds generally have higher valuations, they're more expensive. I don't think they'll do well going forward. Also, index funds. I'm concerned about index funds because they were top heavy with your expensive technology type investments. So therefore, they won't do going well forward. And even going out about another 5 to 10 years, I think people are going to disappoint with the index funds because they've done so well, and they're not going to do well going forward. You may get a 3, maybe 4% return on the next 5 years in the index funds.
Is there any particular sector that we should be investing in or paying attention to?
I still like the value sector because the value looks very good. That has not done well because everybody's excited about the growth, NVIDIA and all these other things. But value is like your food companies, your insurance companies, your financials, and they get hurt when interest rates go up. Now think about that. When interest rates go up, they get hurt. So when interest rates flatten, and then maybe mid next year they go down, what's going to do well? You're ones that were interest rate sensitive. So think ahead and be patient because it's so hard. I mean, that's why investing, that's why it's not easy. I mean, to make an average of 10%, and I think that next year we could see, if you invest properly, got to be careful if you invest properly, you can see a 20% return on your portfolio. I mean, we saw those in the past. I think we'll see them again based on how things are set up, but you got to be in the right investments, and you can't panic and go to cash. That's what worries me. People are like, oh, I'm going to go to cash. I'm going to go in T-bills because I get a 5% return. That is the absolute wrong thing to do. And people get this confused because a 5% return on T-bill is for a year, not for 6 months. So if you do 10% next year on your equities, it would take you 2 years to make up what you've got in that T-bill or that CD. And also, too, guess what? When rates go down after next year, you're not going to get that 5% or that 4% on that T-bill or CD deal. It's going to be less. So think ahead a little bit.
One of the things we always talk about is how investing is counterintuitive. It is, and you can't just be reflexive about things, and you've got to get emotion out of the picture.
You have to. And there's a show that came out, I saw it, Irrational. And people, when it comes to investing in many things, they're irrational. And you have to do the opposite of what you think is going to happen. Because right now, I hear people, oh, things are terrible. Oh, we got to go to cash, got to go to T-bills. I want something safe. No, that is not the time to do it. When you feel the worst and you think, oh my gosh, things are terrible, things are on sale. What's going to happen? Things will improve. They always do. Now, I've been doing this for 40 years. I've gone through about 23 corrections. And a correction is a drop of 10% or more. And I said, that's the only thing I can say I've been right 100% of the time, because every correction I said, no, invest and we did better later on. So do the same thing. And if you need the money in 3 months or 6 months, by all means, yes, don't risk it. But I think we're going to have a very, very good fourth quarter and a very, very good 2024 based on where we see values now, based on interest rates. The economy is doing okay. The job market's okay. It's not having great increase in wages. There's just so many good things to look at, but people focus on that one or two bad things. I better not invest. No, don't do that.
All right, Brent Wilsey, Wilsey Asset Management. SmartInvesting2000.com.
Yeah, website smartinvesting2000.com. A lot of great information there. Got a great newsletter that goes out to people if they want it. All the stuff I talk about, we're always putting the newsletter every Friday for people.
All right, thanks, Brent.
You're welcome.
Good stuff, always.